Solutions with Saurabh. Saurabh, good morning. Fantastic to have you back. Saurabh, I was scanning through my notes of whatever previous interactions we've done.
Right.
And before I get into specifics of what we've discussed in the past and what your thoughts are, the market, Saurabh, is changing, and it is changing very fast. Suddenly, SBI is outperforming HDFC Bank. Power stocks are making a comeback. Anything which has not participated is now considered to be the next big one when it comes to catching a trend. So this market is changing colors, and it is changing colors very fast.
Well, look, these sorts of things happen, right? We're basically, there is a sense of relief that the second wave is behind us. There's this sense that with the vaccination drive beginning properly 3 to 4 months out, we'll be out of COVID, hopefully, by and large. Even if there is a third wave, the hope is that the third wave is small. And in such circumstances, Nikunj, it is but inevitable the sorts of trades that you're describing get done, where people say, why should I buy optically expensive HDFC Bank? I'll instead go for SBI. But what my experience has shown me is these sorts of waves are passing waves. Fundamentally, over the course of a stock market cycle, both through the bull market phase and across a bull and bear market phase, to use the pair trade you were suggesting, an HDFC Bank simply has too much muscle for an SBI to be able to keep up with it. And therefore, we've seen these sorts of things good at one level, because it suggests risk appetite is coming back, confidence is coming back into the market, and that's good to see.
Given that how the shape of the economy, Saurabh, is changing and how things will continue to change, have you identified anything which could be called as a master franchise or a champion from the mid or the small cap space? Because that's what people want to understand from you. We know you like Pidilite, we know you like HDFC Bank, we know you like Asian Paints, we know we know that you like a lot of other pharma companies.
So the themes that we've been playing over the last 2.5 years, very nicely captured in Nikunj. I think a lot of those themes will continue. What we are trying to do is understand as people's psychology changes, right? The last 1.5 years have been a very difficult time for lots of people. And there are changes in the way people think about consumption, we believe. And specifically, there's a coming together of what I would say the specialty chemical skill set with the Indian consumer, the Indian public's need for more cleaning products, more personal care products. In a way, one facet of the changing consumer behavior is the sort of numbers that you're seeing. The Path Lab franchises like Dr. Lal's Post. People are clearly doing more tests, not just COVID testing. People are testing themselves for a whole range of other things that they weren't doing 18 months ago. Similarly, I reckon on the cleaning and personal care front, there is a step change in behavior. And over the past year or so, we've built a substantial position in Galaxy Surfactants. This is the largest manufacturer of surfactants in the country, supplies companies like Unilever. It also has a large business which supplies the chemicals which go into the personal care products that all of us on this program use, lotions and skin care and so on. And that whole combination of cleaning products and personal care products, whether you buy it through Unilever, you buy it through P&G, ultimately the raw material, the specialty chemicals for that are coming from Galaxy Surfactants. So we felt it was the neatest way to play what we think will be a significant and lasting upsurge in consumer behavior, where they buy more cleaning products and more personal care products. Galaxy also has a substantial export franchise. So PAT compounding last 5.5 years has been around the 22% mark. Dominant franchise, strong balance sheet, clean management team, strong R&D capabilities. That's what really drew us to this franchise. Surfactants at one level are a commodity, but this company seems to make a better quality of surfactants, and that too with oleochemicals rather than with petrochemicals. And it stands out therefore from the crowd. So one simple way, I believe, to profit in the post-COVID world would be to look at Galaxy Surfactants, and we built a substantial position in that.
Sort of one stock which, in a sense, you've always owned and you've admired the company in terms of the capability they have and the market share and the mind share they have is HDFC. Life, HDFC Insurance, to simplify it for our viewers. How do you view the life insurance space changing in the light of pandemic? One, there is need to buy more insurance, but on the other side, you've got an LIC IPO coming, and also what is happening on the reinsurance side in terms of the premiums going higher.
So I think that there are three massive trends in financial services, which is playing out, and in a way, all of us are benefiting from it. One is the relentless market share shift from public sector entities to private sector entities, whether that's in banking, life insurance, or general insurance. It's a very powerful trend, and HDFC Life too benefits from that trend. The second is on the back of what transpired with ILFS and Yes Bank and DHFL. A whole bunch of things have happened, right? Regulatory changes in the credit rating industry, changes in the mutual fund industry, and it's become much harder for weaker players with more doubtful financials to raise money at low cost, whether that's debt or equity. And therefore, across financial services, you're seeing market share migrate to cleaner, stronger players. HDFC Life, I think, will benefit from that as well. And the third trend is the financialization of savings. Right, the RBI keeps saying that 95% of India's household savings are in physical assets. No other country ever has had a skew like this. And we are all seeing in front of us, gradually India's household savings financialized. This trend is massive. At the moment, household savings, household financial savings put together is $500 billion. My reckoning is a decade out, that number will be closer to $2 trillion. Household financial savings will go to $2 trillion, I reckon, from the roughly $500 billion. So HDFC Life, or generally life insurance players, health insurance players, asset management companies, wealth management companies benefit from that as well. So I see HDFC Life at a very powerful intersection of the migration of market share from public to private, the migration of market share to strong, well-run financial services companies, and finally, the financialization of savings. The company does have strong competitive advantages around data analytics, and their underwriting capabilities, we think, are the best in the country.
Okay. Saurabh, sounding very upbeat and confident about the recovery and sort of how we're going to move ahead from here. Tell me, what kind of growth momentum do you think we're looking at? I ask in terms of what really we should anticipate, whether it comes to the pickup on the infrastructure cyclical side or whether it comes on the demand consumption side. What do you think is a reasonable rate to expect, and how are you factoring that in when you're looking at your portfolio as well?
So I think just to sort of take a cue from where Nikunj began, it is clear globally you have a very strong cyclical recovery. As we discussed, I think on our previous interaction, our global commodity demand is probably the strongest it's been in 8-9 years. And it does look at the moment that in commodities, demand is outstripping supply by a considerable amount at the moment, right? So as we saw in the fourth quarter of this year, in India too, we will continue seeing a Capex recovery. The fourth quarter GDP data clearly points to a Capex recovery. And in fact, in April, May this year, we had some of the largest steel companies announce for their first steel plant Capex that I've heard for, I think, 7-8 years. So the Capex cycle is underway. And therefore, as Nikunj was saying, there's a whole wave of market activity where people will rush to play the Capex cycle. Our view is, one needs to be a bit more considered about these things, right? Fundamentally, a bull market in commodities means input cost pressure. It means inflation. And therefore, one needs to invest in strong franchises which have the pricing power to deal with the inflation, which have the pricing power to protect their operating margins as the inflationary pressures come through. It looks all but inevitable. Not all across the world, commodity prices will come up strongly. Inflation will come up strongly. And therefore, our focus, as ever, is to invest in powerhouse franchises which have the pricing power to make sure that the top line growth comes through to the bottom line. And that's been the focus for a long time. And we'll carry on sticking to that, although I fully appreciate and understand there's a whole group of people who are running after a high beta plays on the back of the global economic boom.
All the new paper that's set to hit the market, Saurabh, this year. What are your thoughts on that? How do you think the market's going to respond? There are some really big bang IPOs that are slated.
Yeah, I think at one level, I'm very happy that the LIC IPO is coming, because with a massive IPO like that, the powers that we have to keep markets in good humor for the rest of this fiscal, at least, if they want a blockbuster LIC IPO. I think that will be at many levels. The LIC IPO at many levels will be a watershed for the Indian market. It's probably the last big PSU which was owned by the government, and now it'll go public. But more generally, there are other interesting IPOs coming. And again, it's a sign of risk appetite, right? The bankers who are underwriting these IPOs, who are bringing these companies to the market, have done their homework. I'm sure there's been plenty of discussions with global investors and local investors. And my reckoning is that this will probably be the strongest year for IPOs. Current fiscal will be the strongest year for IPOs since FY 07-08. And you got to, I think we've discussed this over the years. Finally, we're seeing good companies with strong investors behind them, strong franchises heading to the market. So it'll be interesting to see. I mean, LIC, Zomato, Aptus, all in the same year. Interesting times ahead for the market. Plenty for everybody watching this program to do this year.
Exciting times. I want to probe you a little bit more on the consumption side of it. There is a thought that this time around, post the second wave, it won't really be pent-up demand that we'll see, but actually the impact of a dent in savings. There's conflicting views that have been coming in on how this will really impact discretionary or even recovery plays like travel, hospitality, etc. Which side of the fence are you on this, Saurabh?
No, I think as we saw after the first wave, right, as we saw through the winter months, and especially in Jan, Feb, March, I think we'll see a reasonably quick pickup in both the Capex cycle. The Capex cycle, as I was saying a minute back, looked in very good shape Jan, Feb, March, as per the GDP data, and also as per corporate earnings. So I think that will come back inevitably, given how low interest rates are, how commodity prices are shaping up globally, and the supply-demand mismatch in commodities. I think on the consumption side as well, already there's enough evidence that even in the first 10 days of June, you're seeing demand for durables, demand for electronics come back. And I don't belong to that school of thought that believes that there'll be some massive period of Indian households rebuilding their balance sheets. Sure, there have been a lot of small businesses who have suffered really, really badly over the last 1.5 years. And to that extent, there could be a dent in the ability of small business owners to quickly get back on their feet. But generally, whether it is demand for cars, demand for FMCG, demand for electricals, I think by August, September, we should see a fair bit of normality come back in those spending patterns.
Saurabh, on the subject of the commodity cycle, and many have begun off late questioning as to how more legs does this super cycle have, and whether or not this is a super cycle we're currently in or not. Metal stocks as well, while they've had a fabulous run the last year and a half, they too are getting a little bit in a consolidation mode. That may be par for the course, but is the best really behind us? And do you need to really go back to the drawing board and rethink your commodity investments?
So look, Aisha, I'm no commodity expert. I've never invested in a metals and mining stock in my career. But from what I can see, you still have a supply-demand mismatch, i.e. demand outstrips supply. The latest generation of supply, i.e. the post-COVID supply, hasn't yet come on stream. Right, so the plants have been announced. I think in India, we've had 2 steel plants announced in the last 3 months or so, and globally as well. The plants, the Capex announcements have been made, but the new supply hasn't yet fructified. Until the new supply fructifies, and that's probably 2 to 3 years out, it's difficult to see why there'll be a big abatement in this supply-demand mismatch that we are seeing globally. Not only am I not a commodities expert, I don't fully understand what's happening in China. China will obviously be a big part of this of this commodity cycle. But generally, my sense is I haven't heard of new steel plants or aluminum plants coming on stream either in India or anywhere else in the world in the last 8-9 months. And all we've heard is booming demand for cars, booming demand for industrials generally, and therefore a finite supply of commodity meets rising demand, and therefore the inevitable implication is rising prices.
I'm quite surprised and shocked to hear, Saurabh, that you've never invested in a metal stock. Completely missed out on the rally then?
Absolutely, absolutely. We're happy to miss out on such things. We've got companies in our country, large companies, where we get free cash flow compounding at 30% regularly. So just using the last 5 years as an example, we've had Page Industries give us free cash flow compounding at 35% the last 5 years. Asian Paints, one of my favorite stocks, give us free cash flow compounding at 20% in the last 5 years. We've had Titan give, I think, free cash flow compounding of 45-50% in the last 5 years. So if you have names like that in this massive economy, companies that consistently gun out 20, 30, 40% free cash flow compounding, we just prefer to stick to that game of steady wealth generation rather than use our limited brain power to figure out the commodity cycle. The commodity cycle is tough to figure out. We are no experts at it. Hence, we keep away from metals and mining stocks.
Saurabh, you've used this example before that out of the 15-20 stocks you own, there are some stocks which in a sense could see growth in earnings, but the stock prices may not grow because of variety of factors. Which are the stocks where you think the earnings have grown and markets are not recognizing them and the leaf period, the chutti is about to get over?
I think generally, if you look at front rank financials, I think we made the point a few minutes back, Nikunj, about HDFC Bank. If you take the premium lenders, let's focus specifically on the top quality lenders in India, HDFC, Kotak, Axis, Bajaj Finance, to take 4 lenders which we have exposure in different portfolios. I think the last 4-year EPS compounding, including the COVID dip, the last 4-year EPS compounding across HDFC, Kotak, Axis, Bajaj Finance will be in the vicinity of 19-20%. But I don't think the share prices have compounded at 20% for the last 4 years. And hence, it makes it, I think, all the more seductive for us. You're going into an economic upcycle. These 4 lenders' tier 1 ratios will be around 20%. So they're vastly overcapitalized or appropriately capitalized going into a strong recovery. They won't need to raise capital for the entire economic upcycle. And therefore, you're playing 4 super strong lenders going into an economic recovery. And therefore, to our mind, this trade, which we are playing through our financials PMS called Kings of Capital, this trade in top quality lenders with strong balance sheets, sensible capital allocation. To us, this is a far more seductive, far more appealing trade than trying to time the metals and mining cycle.
We appreciate your time. Stay safe, Saurabh, and thank you for your valuable thoughts. Okay, I'm just going to take a